So if there is large and interchangeable inventories, we have two methods. One is FIFO and weighted average. LIFO is prohibited under IFRS. Large and interchangeable means they are replaceable. It doesn't matter like which is being sold first and which is being sold later. It doesn't matter at what prices they're coming in. But since they are large and interchangeable, we can replace them. We can interchange them. We need to use either FIFO or weighted average for them. If they are not interchangeable, we can use retail method or standard costing card as a basis to value those inventories. FIFO is first in, first out. It is assumed that the first inventory which has come in is going to get sold first. Whatever is remaining becomes our closing stock, and we need to value the remaining stock on the basis of which inventories came in first. They have been sold first, so that at the price they were bought in first, that same price goes out in the form of cost of sales. So what we are left with? We are left with the inventories which are still remaining with us, and we value them on the basis of the price which still remains with us. Average price is, if we are buying 100 units, 20 units a different price, 30 units a different price, 40 units a different price. Whatever is the total units, 100 units, whatever is the total amount we have spent to buy those 100 units, divide the total cost by total units, we get the average price. And what is the average price of all the units we bought till date without bifurcating them in the form of when did they come in and when did they go out? We simply calculate what is the total cost, what is the total number of units, average out what is the price as of today. Here's an example. Freya sets up a business on 1st September buying and selling CD players. These were purchased during the month as follows. So it is your turn now. You need to give me the value because FIFO and weighted average, I think you've been doing since ages now. So please tell me the value under FIFO and weighted average. It is your turn. So let's have a look at the answer now. 5th September 200 quantity, 16th September 80, purchase at different price. We sold 250. So how many units we are left with? We are left with 30. 30 of the price. First units which are coming in are sold out first. So we are left with the ones which are at a price of 185. Purchased 200 units, 80. We sold 250. We are left with 30. So 200 of 150 price were sold and 50 of 185 price are sold. 30 of 185 price are remaining with us. The closing inventory is of 30 at the rate of 185. This is under FIFO. Weighted average. If I talk about the proceeds are 50,000 on it. Cost of goods sold is 39250 on the basis of FIFO method, and we have profit is 10,750. Under weighted average, we bought 200 units. Now it takes into account total units. So total 280 and total amount becomes the cost per unit. That is $160 per unit. Whatever units we are left with are priced at 160 into 30. So what are sold are priced at 250 into 160. What are remaining are also sold at 30 into 60. Proceeds are 50. Cost of goods sold. So there's a difference of 750. This is simply because of the difference in method in the valuation of closing stock. Here 30, the difference between 160 and 185 is 15. Number of units are 30. 15 into 30, difference is 25, sorry. 160 and 85, there is a difference of 25. 25 into 30, 750 difference. 750 difference in profitability, because 750 has got reduced in the form of closing stock in the cost of goods sold. So that creates a difference between two methods. So we use only one of them consistently, so we don't use both. So the profitability will be different temporarily. Hope this is clear. What is NRV? NRV is the net realizable value. As I said, in case of inventories, it has to be cost of completion as well as cost to sell. Because if the inventory is not complete, we cannot sell it without completing it.
Sorry, just going back to that. So I'm just thinking that which method is more prevalent or more used? Is it FIFO or the weighted average?
It depends on companies. Like it's not both are equivalently used, but FIFO is more clear than weighted average. FIFO gives more fairer presentation than weighted average, because it is taking into account the real amounts which has come in first and going out first, believing that, because that's also a normal thing, that The units which come in first, the seller would like to sell them first. The units which come in late, the seller would like to sell them late. So FIFO is more fairer in comparison to weighted average. Company policy, depending on their accounting processes as well as costing as well, that what is more convenient for them to follow. So it's not always fairer presentation. It's also the costing as well. If weighted average is easier for them to implement and cost them less, they may opt for weighted average. So it will not make much difference to the fairer presentation in overall overall purview of IFRS. Okay.
Right.
So if your business decisions are not always just about accounting, it's about how much will it cost. Like I wish to use revaluation model, but revaluation model is costly affair. So I would like to go with cost model. So it's not always the intent fairer presentation. But if you're following one of the policy, you are in compliance with IFRS. Okay. But if you wish to set benchmarks, you may move on to the choices. So there are choices available because there are some entities who wish to move on to the next level of fairer presentation. So IFRS or ISB has no choice other than giving a choice. Where someone is willing to give fairer presentation, someone is not willing to give fairer presentation, they want to reduce their cost. Someone is willing to spend on fairer presentation. So is the reason they give a choice. Clear?
Yeah, right. Thank you.
So NRV is, as I've already discussed, it is favorably less cost to sell, less cost to complete, because the inventories may not be complete. If there's any money required to be spent, that reduces our NRV, net recoverable amount. Why NRV happens or why it reduces? Because of damage, obsolescence. We may not be able to recover what we are intending to recover in the form of cost. Decline in selling prices or increase in estimated cost to completion may also result in a reduced recovery. So if our cost is higher than recovery, we need to indirectly impair it through the IS2 inventories model. Automatically takes care of impairment at the end of each year. And since they are going to be sold within 1 year, again, we do not need to test them we do not need to wait for indicators of impairment to do it. So the reason IS 36 is not applicable to it. Automatic impairment system inbuilt, recorded at lower of cost or NRV. So a new assessment is required to be done at the end of each year. So in the statement of comprehensive income, we'll be recording the cost of materials and consumables used, write down of inventories, reversal of write down of inventories. Now, if you have reduced any inventory in future, if the price reverses, we can reverse it to the extent of cost. Now listen to my line carefully. Reverse it to the extent of cost. Because if you reverse any inventory beyond cost, we are actually trying to enter into revaluation model, which is not allowed in IS2 inventories. So remember a tip in IFRS that if anything falls and if there is any provision for reversal of that cost or reversal of those losses, it can only happen till cost, not beyond it. Because if you increase the assets value beyond cost, you are actually trying to use a model which is not even available for that standard. So in case of IS 16 property, plant and equipment, if there is a reversal of impairment, if you're using cost model, only it can happen till cost. But if there is a reversal of impairment and you're using revaluation model, the revaluation model automatically takes care of those increase or decreases. Did you notice this? The revaluation model is capable enough of taking care of any increase in value in future, any decrease in value, any fall in value, first time revaluation, second time revaluation, first time upward, second time downward, first time downward, second time upward. The model itself is able to take care of any future reversals. But if it is cost model or if there is any reversal of impairment, it cannot go beyond cost, because if it goes beyond cost, you're trying to enter the arena of revaluation model, which is not allowed if that's not your company policy. So the same is applicable to write down of inventories. It cannot go beyond cost. Even if it reverses, it can reverse up to the extent of cost. Got it? Which you must have noticed even in IFRS 5 non-current asset held for sale, when I said that what if we change the plan? What if we change the plan? It can only go to the extent of, what if you change the plan? It can only go to the extent of cost, not beyond it. So we'll calculate as if what would have been the cost on that date if there was no classification as non-current asset held for sale. So cost is important aspect. We cannot change it the way we wish it. Clear? So we need to disclose the accounting policy, carrying amount by category, fair value. If there's any inventory pledged as securities for liabilities, the whiskey can be pledged as security for liabilities. It happens, it works. amount of any reversal of write down or cost charged to expense for the period is shown or disclosed. Here's an interesting one for you. So if you notice here, there is a different purchase units given. And in the question, it says that we are left with 150 units. If you're left with 150 units, 150 from behind, the 100 units which came in first are sold out first. 60 units which came in first are sold out first. We are left with 150. And the financial year is ending on 31st December, if you noticed. 31st December means that 70, 60, 130 and 20 from the 100 is also still with us.
Yeah, I was thinking that we have purchased around, say, 230, right? And we have sold by 31st of December,
Yes.
130.
But 230 we have purchased till that point, and so we sold 150. Sorry, we had sold the remaining. We are left with 150. So 70 into 506, 60 into 503, and 20 into 500. That's our valuation of FIFO. Now we need to know the realization price, selling price, NRV. Now, if you noticed, after 31st December, we are selling at 524. We are selling at 522, and there is a 5% selling price, selling brokerage as well. The selling and distribution cost as well. So NRV is selling price less cost to sell. Admin expenses we may not include, but selling price less cost to sell we will take into account. So selling prices are these, and selling prices are available for 14 January. So we are required under IS2 inventories that we are required to estimate net realizable value as on 31st December. But when we have the real figures, so in reality, in practical life, what happens? We actually get the real figures as well, that the real value at which we sell. So though IFRS believes that we are doing it on 31st December, but in reality, it is asking us to estimate it. So estimated selling price can be 524 minus 5%, 522 minus 5%, and 520 minus 5%. And we can know that at what price we would have been successful in selling these 150. So we would have been selling this 50 at a price of 524, 80 at a price of 522, so 130 and 20 at a price of 520. If I take you through it. So first question was state reasons why NRV may be less than inventory. It is damage, obsolescence, declining selling prices, and increasing cost of completion or cost of making that sales. The second question was calculate the nearest value of inventory at cost or NRV and amount to be included in financial statements. So cost on FIFO basis was 70 at the rate of 70, 60 and 20 at the rate of 500. 70 at the rate of 506, 60 at the rate of 503 and 20 at the rate of 500, because we are still left with 150 units. So 70, 506, 60, 503, 20 at the rate of 500. We have been successful in arriving at cost on FIFO basis. Now look at NRV. NRV is 5% less. So whatever is the selling price, the selling price is 524, it is 5% less, 522, 5% less, 520, 5% less. This will be applying to what if we would have sold 50 units, we would have been successful in selling them at 524, 80 units at 522, and remaining 20 at the rate of 520. So we would have been successful in selling 70 units on 14 January. If you noticed, we were successful in selling, these are units purchased, 50, 80, 40. We have been successful in selling 70 units on 14 January. So out of 150 units, if we sell 70, we will be able to sell at 524. 50 units will be able to sell at 522, minus 5%. 524 minus 5%. 70 plus 50, that is 120. Remaining 30 will be able to sell at a price of 520 minus 5%. So we'll be selling 70 at 497, 50 at 495.90, 30 at 494. We'll be able to sell 70, 50 and 30. The 150 units we carry are supposed to be sold at this price. Now in this question, we were given the net realizable value of future, so we are required to estimate. So we can use the NRV on estimating selling price, and estimating selling prices are available to us. We can use this to know the NRV. Is this clear? Hello. Is this clear? For costing, we know the purchase prices. For selling NRV, we need estimated selling prices. And estimated selling prices of 14 January, 28 January and 11 February were available with us. So we could estimate the selling price, though they are given in real terms. So, but as on 31st December, we need to estimate. So we have taken these values as an estimation on 31st December. Is this clear with everyone? Any doubt? Hello. If you have doubt, you can ask, like I can repeat it. I can go back. Units purchased, the cost of purchasing. Units sold, the cost of the price at which we are selling. The price at which we are selling till 31st December is of no use to us. But after 31st December, whatever price we are selling serves as a basis for estimating our selling price, estimating our net realizable value. And we use these values 524, 522 and 520 as a basis for estimating our selling price less cost to sell to know the net realizable value of 150 units. We have the cost of 150 units, we have the NRV of 150 units. What do we need to record at? Lower of cost or NRV? Lower of the two is 74,461 is the value at which inventories will be recorded in the books at lower of cost or NRV. Fine.